Replacement value, as the term implies, takes into account the amount required to replace the existing company. In simple terms, it would be the total cost required to build a similar company. Replacement value is also known as substantial value. Here is an example. The balance sheet of company ABC Limited is given below. Going by the below assumptions, find out the replacement value. The first assumption is 20% of the fixed assets are unused. And the second assumption is that the market value of the assets is 50% higher than the accounting value carried in the balance sheet. Let's draw a table and calculate the book value. From the balance sheet, we have total assets. We need to deduct long-term debt, short-term debt and creditors, that is 4,800 minus 900 minus 300 minus 1,200 to give 2,400 as the book value. Question carries two assumptions and therefore we need to come up with a replacement cost adjusted balance sheet based on them. Before we could do that, we need to recalculate fixed assets based on the assumption given. Fixed assets is 3,000 and therefore 20% of it is 600. Market value of assets is 50% higher, which means after revaluation, the adjusted cost will be at 150%. Let us revalue the fixed assets part. Fixed assets original carrying cost is 3,000. We already have that from the table. 20% of 3,000 is 600. Balance fixed assets is 2,400, which is 2,400, and this is derived from the calculation of book value. And after evaluation at 150%, it would be 3,600. Here you will note that the asset value after revaluation at 150%, which is 50% higher, that is a hint from the question, has gone up from 3,000 to 3,600, showing an increase of 600. It could be in million or in lakhs based on what currency you are following in the question. Now let's draw the replacement cost adjusted balance sheet. On the left side, the only change is adjustment of rupees 600 derived from the assumption of 20%, that is 3,000 into 20 divided by 100. And on the asset side, the fixed asset is revalued at 3,600 instead of 3,000. All other line items remain unchanged from the first table given in the question. Finally, we have all information to calculate the replacement cost. Total assets from the balance sheet is now 5,400. This need to be subtracted from long-term debt, short-term debt and creditors. Therefore, 5,400 minus 900 minus 300 minus 1,200 will give you 3,000. Hence, as per the replacement value method, the value of the company is 3,000 in million or in lakhs.